Good afternoon, everyone, and welcome to the July NatWest monthly FX webinar. My name is Paul Robson. I'm head of FX strategy for Europe here at NatWest, and I'll be your host for the next 40 minutes or so. I'm very pleased to say that I'm joined, as usual, by Piers Leslie, who works for fact, not fiction forecasting. I'll be covering off the fundamental outlook for the major currencies, and Piers will be using technical analysis to shine a light on what he believes are drivers of currencies at the moment, and crucially where the sort of balance of risk are when we look to the future. We will have time at the end for a Q&A session, so as David just said, please feel free to submit questions, and we'll get through as many of those as we can towards the end of today's webinar. Today's part of the webinar list called Debrief, and what I wanted to do is to have a holistic view of some of the drivers of major FX rates over the last couple of months, because I think if we have an understanding of what drives currencies, and crucially actually what hasn't been driving, then I think that gives us fully armed to look to the future in terms of FX rates. David, could I have the first slide, please? So this first slide just tries to pick out 5 what I think is important drivers for sterling, the euro, and crucially I think for the dollar. Sort of divide them into 2 very broad groups of what I think has been driving currencies, and also where FX markets have sort of become desensitized to, that they traditionally have been important drivers, but they just don't seem to be impacting FX rates as much as they have done in the past. So the top right of this first slide are the 2 drivers that haven't really been having an impact. The bottom left are the 3 that I think are very important actually for sterling euro and sterling dollar. So in the top right, we have trade tensions. They were obviously very much in focus this morning, and late yesterday we had another round of escalation in terms of US trade policy, tariffs. But markets have sort of met each headline perhaps with less enthusiasm than they had, say, back in April when you had Liberation Day, in the words of President Trump. And I think there it's because we have this ebb and flow of escalation and de-escalation and deadlines that have been extended. We just had another one from the 9th of July to the beginning of August. That's obviously a short deadline extension, but nevertheless it's another one. And also, ultimately, I think people think that the landing zone for tariffs and trade deals will be not as troublesome as perhaps some of the noise around some of the announcements. Now, that said, if we think about the last 24 hours, talk of significant tariffs on copper imports into the United States, and also potentially in pharmaceuticals as well. You've got a combination of sectorial tariffs, you've got reciprocal tariffs, and also you have a range of tariffs if the US administration believe that trade has been carried out unfairly. But the impact on currencies, as I say, it's been desensitized. Another one, and although this is specific, it is a good example of big geopolitical events that haven't really moved the needle on currencies, and that was the Middle East. The tensions in the Middle East ended, I think, well, they escalated very quickly and they ended more quickly, very much like the first Gulf War relative to the second Gulf War. But even in the run-up to the rising tensions, FX rates weren't particularly moved. And I think it's because of the oil price was also relatively decentralized. But I would say that markets seem to want to use FX as a way of articulating views on what was happening rather than, say, equity markets and bond markets. But in general, the beta to the events, the sensitivity to the events did seem to be somewhat decentralized. The bottom left of this chart shows the ones that I think have been driving markets, and I think they will do into the future. So right at the bottom, you've got asset reallocation from the US. I think that's a movement of capital away from the US and the dollar into other countries and currencies. And I think that's going to be the dominant driver of currencies for the rest of the year, particularly about the dollar. Beyond the dollar, I think FX rates are relatively stable. The other two drivers are very specific for sterling, both against the dollar but also against the euro. So I think the biggest risk for sterling remains one of fiscal policy. That was in focus very much last week, but that's the third episode just this year where you've had a spike in government bond yields and sterling has weakened. And I think that that's definitely something to be watched. I think it's a driver of the euro as well in terms of expansionary fiscal policy in the euro area and the European Union. And also you've just had the budget bill in the United States. And part of that is also related to tariffs and tariff revenues and paying for tax cuts. So I think that's definitely something we'll be paying more attention to over the next 6 months or so. And the third one still remains where interest rates are heading. And both the Bank of England, US Fed, and the ECB, European Central Bank, it seems to be a more dominant driver of sterling euro than sterling dollar, which I think is interesting. And I think it plays to that first point about asset reallocation, that if the dollar isn't being moved by interest rates, but is still moving, then we must look for other drivers. And one of them will be this reallocation of assets out of and capital out of the United States related to the policy changes in the US, not necessarily the Fed, but in terms of foreign policy, domestic policy, and crucially, international trade policy, which I think is fundamentally important. David, could we have the next slide, please? So that was just a sort of starter to how we can pitch the FX outlook for the major economies, the kinds of things that we need to concentrate. I'm just going to spend the next few minutes just having a quick update on taking the temperature of the UK economy, because that's obviously important for sterling. So these two charts, I think, are just a nice way of summarizing where the economists think the economy is going and what's the main economic indicator that we need to think about when we look to the future. The left-hand chart is how forecasts for the UK, Euro area and the US have evolved over time. Because obviously economists change their views of the world, and the triangles are where NatWest economists think will ultimately end up. And for the European economies, things have been relatively stable at relatively low levels of economic growth. The US outlook deteriorated really quite sharply at the beginning of the year, but equally has stabilized as you've had this de-escalation of trade tariffs, and I think that that's ultimately right. The big worry for the UK outlook is whether it hit a brick wall between the first and second quarter. This was a time when you had the national insurance contribution increase. It was a time when people were worried about tariffs, US tariffs, and it was also the time of the national minimum wage. And that right-hand chart shows the change in employment in the UK, payrolls, companies telling the net revenue how many people will ultimately be paying tax in that particular period. And you can see we've had a real sharp decline in employment. And if that persists, that's 109,000 jobs being lost in 1 month. You can imagine if you annualize that up, that would be a significant change. And I think for sterling, over the next couple of months, the outlook will be determined about whether this deterioration ultimately gets revised away. And ONS statisticians did warn that it should come with a health warning, or it persists. And if it persists, then it feels like the Bank of England will be cutting interest rates much more aggressively and below where we here at NatWest believe the rates are going. So a relatively good performance from the UK at the beginning of the year, stable outlook, but really quite worried about deterioration in the labour market. But one caveat here is the red line, which is a survey-based measure of employment. So that normally picks the trend quite well. You can see that that hasn't deteriorated. So perhaps it was only a short-term blip in the economy, and we're going to start. Have the next chart, please. I think a lot of people will be familiar with this chart. It's simply inflation in the UK and where it's come from, and what are the drivers. And you can see that after the peak in around COVID and the energy price shock, inflation has come down. We think we get a little bit of a blip in inflation, but ultimately we continue to go lower. And this will be ultimately what the Bank of England will be focusing on, which is the blue bars, which is the service sector. But it still remains uncomfortably high relative to their target of 2%. But if inflation was to come down more quickly, the Bank of England would, we think, ease more quickly, and that would lead to some softening in the currency. Next slide, please. So what does this all mean for the Bank of England outlook? We still think that the Bank of England stays cautious in cutting interest rates. I think they're confident that inflation is coming lower because growth is weaker, but they're also scarred by how persistent inflation has been in the past. So we continue to think that we'll get quarterly rate cuts from the Bank of England in August and November. That's 25 basis points a cut, so a quarter point of 1% each quarter, getting us down to 3.75% by the end of the year. Markets, which is the blue line on this chart, are a little bit more confident that rates head lower into next year. And I think that's because they have a more pessimistic view of the economy in terms of inflation coming down, but that labour market weakness that I've talked about. Just in context, the other chart, the right-hand chart, shows what NatWest economists are expecting for the US policy rate against what markets are expecting. You can see that we continue to think that the risks are that the Fed doesn't cut interest rates aggressively this year or into next year. Next chart, please. These two charts just really want to just reinforce the point about the risk to sterling is fiscal policy. So the first chart here is the level of debt the government has relative to the size of the economy, 100% of GDP. The UK has big borrowing requirements. It continues to run big deficits. Debt servicing costs are high and growth is weak. And when markets worry about fiscal policy and long end rates rise, then sterling it can often be significantly weaker. And we saw that, as I said, in January, in April, and again earlier this month. And I think some of these risks will come to a head into the budget in late October, November, and that's something we think is a risk event. And this chart, just very quickly, just shows, supports what I was saying on that first slide about sort of interest rates and the dollar and what's driving the dollar. So the left-hand chart is the relationship between sterling dollar, which is the dark purple line, relative to the interest rate difference between the UK and the US. And you can see that in the past, the relationship has been relatively good. But since the beginning of this year, the relationship has started to loosen. And I think that that's sign that it's a sign that capital is leaving the US. If it's not interest rates driving the dollar, we have to look for other suspects. And one of the usual suspects will be capital outflow. And I think that's related to the aggressive policies of the US administration, which is seeing people revisit their appetite to hold US assets. They might be looking to increase their hedging of their dollar exposure, and reserve managers rotate out of assets. The relationship between sterling euro, euro sterling, whichever way you want to look at it, is a little bit tighter. And I think that's because it's less influenced by what's happening in the US and more about interest rate expectations. And that's why the Bank of England outlook, we think, will be really quite important. And those employment numbers, we get an update on July 17th. I think I'll just miss this one out. David, if we could just move to the next one. This is just reinforcing the point about how we should think about sterling dollar and the dollar in particular. And I started with it watching the money. It's always good to look where the money is going. And just a couple of things here. There is I think the title of that first chart is, it's right. If I just concentrate on the right-hand chart, that shows the dollar's share of global FX reserves. So around just under 60% of $12 trillion of global FX reserves are held in the dollar. And if people start to think about not wanting to hold the dollar in such a large proportion of their assets, then small changes in the holdings of those $12 trillion can have a significant impact on the dollar going forward, and how quickly that happens over what kind of time frame as well. So we still think that the dollar can weaken. We still think the dollar weakens over the next couple of quarters at least, and it's a slow burning theme, not something that can be adjusted relatively quickly. And then just, I believe, the final chart. And so these are our current set of economic forecasting. For comparison, I've included the Reuters poll, so you can see how our forecasts relate to the market, both the mean forecast for sterling dollar and sterling euro, and also the minimum for each of these. And the thing I draw attention to here is that we're relatively in line with the consensus. We're looking for relatively small moves, but the range of forecasts are particularly large. And I think that reflects the uncertainty around the outlook. And just the final slide, please, David, which is the disclaimer, which is a very important slide, and I would suggest that you take time to read that later in context of what I said today. And with that, that ends the first part of today's webinar, and I'd like to now turn it over to Piers Leslie, who will be running through a technical outlook for major currencies. Over to you, Piers.
Thank you very much, Paul. Very interesting stuff there. We'll kick off mine with sterling euro on the next slide. I thought I'd start with this because it's the easiest one just to start with. It's a very simple chart. I'm going to try and look at the quarterly charts more today because we've just ended the second quarter, and it gives us a good time to have a look at what's in store potentially for the next quarter. So sterling euro is very simple because since Brexit, the market's only been concerned about three areas in sterling euro. The first is the 107.40, the very bottom blue line across there. That was been the low about 6 or 7 times the market's been down, tested that, and that's where the market just buys sterling euro and it rallies back up. The next one is the first retracement area in the blue circles, and that's what I'm going to call a pivot here, the 23.6%, and that's 116, so basically the 115, 116 area. And you can see that every time price is below that, it uses resistance. When it goes above it, it uses support. And that's just been the case for about 8 years. The last one, the final one, is the 38.2%. And that's been a level that I've had on these charts, since pre-2020, that this is the area where the market just sells it. It's as simple as that. So for sterling euro to really change, you need to see those three break, particularly the outside two. So if you expect sterling euro to go higher, you need to see it take out that 38.2 at 121.5. Now, last time we had the quarterly webinar, where I did the quarterly charts, we were just had a negative quarter falling off the 38.2, and I highlighted the 116.23.6, and all sterling euro's done is simply go down to that 23.6 area. So at the moment, I'd look at short-term support at the moment in here around about that 115, 116 area. If that was to break, there is quite good support in the 111, 113 area, and that's from those previous lows. You can see at the orange line that I've drawn. So that I expect that area to hold sterling euro for the time being, but you could see a move down towards that 111, 130. And then to get positive on sterling euro, you really need to see a move back up through 118, 119. And only if it can break through that 118, 119 are we going to retest that 121.5. It's also just worth noting that yellow sort of color on the chart. That's the Ichimoku cloud. It acts as resistance when you're below it. You can see it had 2 quarters, 3 quarters where it tested it and it fell off it. So that's another area that sterling euro's got to contend with. But just watch those 3 areas in the very big picture. They're the main ones to watch. And then shorter term, I'll keep you posted during, in between these webinars on the weekly charts. So if we go to the next slide. Thank you. Here's an example why it's very important to look at the weekly charts that we send through. They go out on the NatWest weekly. This was a very good signal, a warning signal. You had an uptrend in sterling euro from 2023, the beginning of 2023, all the way through 23, all the way through 24. You had higher highs, lower lows. Every time it hit the trend line, price bounced. At the beginning of the year, we had a signal that something was wrong. You got a lower high, and I pointed that out in the weekly chart. Something's changing on sterling euro. Look for pressure on the trend line. We went down to the trend line. It held for a couple of weeks. Then it broke below it. But another signal that the market isn't that in love with sterling euro is that when the market rallied back up, it retested that trend line and simply failed. It had 3 weeks where it hit that trend line. And each time it failed at the trend line. So that's 3 weeks of opportunity to know, look, something's changing here. And where have we gone? We've fallen off that 120 area back down to the 115, 116 area. So that's called the rule of polarity, old support and resistance switch. So we're going to keep seeing that. It's a recurring theme. But that's why it's important to look also in between these webinars and keep an eye on the weeklies and the daily charts, because there's some good signals come out of there. So the next chart I'm going to look at is the dollar index on the next slide. Thank you. And this is what drives FX markets, the dollar. So it's very important to know what that's doing. So on this slide, I'm just showing you the whole move up since 2008. Since 2008, it's been a bull market for the dollar. It's got higher highs and higher lows. But now something's starting to change. You can see those 2 orange dashed lines. That was an upward channel. And so that should hold. When it gets back down to the bottom of that, the buyers should buy in because, look, this is the opportunity. They expect it to go back higher. This is a buying opportunity. If we go to the next slide, I've actually zoomed into the end bit just to make it a bit clearer. So this is the end of that chart that I had just zoomed in. So here you can see quite clearly, we closed slightly below that dashed orange line. You also close below that pink 20 period moving average line. So that's negative. So that supported it before, but that's gone. And also you opened the highest price last quarter was the opening price for the dollar. And by the end of the quarter, that was the lowest price. All it did was go down. So that's a very negative when you see open at the high, close at the low. And it makes me think that there's going to be more pressure on the dollar. Now, on the last webinar, I had that line on there, 96.35, on the last quarterly charts I did when I did it in April. I put that dashed line and said that should be support. And I'm glad to see it actually bounced off there so far this quarter. So that's going to be the first area to watch as support. So if you start to get below there, it really does open a move down sort of towards the 94 and then 92.75 area, 92.73, the 50%. But we could see a rally on the way. So you could see a rally back up towards that moving average at the 100 area. So where would I look for resistance in the dollar at the moment? I think moves up towards the 100, 102 area is where the dollar I would expect to get sold back off. So if you see some short-term dollar appreciation, I don't think it lasts that long. I think it will just then get sold off. Where does my view change? Where do I have to say, look, I'm wrong on that? Is if you start to get above 104, then something's changing. You know, you've taken out all the negative feel from last quarter. But that would need something to happen, I feel. You're also below the 38.2% at sort of the 98 area, 97, 93. So all those things just tell me this is where the buyers should be, but they aren't rushing in. So it just makes me think that structurally the dollar is in a bit of decline now. So it's struggling with that run up from 2008. It's starting to show real signs of fatigue and people not wanting the dollar. Right then, so if we go to the next slide, this is cable. Let's look at sterling dollar. So this is from last month's webinar. And I put out this rule of polarity again. It's a very simple thing, but it works very well. So you look at the old support. This is the yearly chart for sterling dollar. And I highlighted this 138.32 area, the 23.6%. And if we go to the next slide, please, you'll see this is it updated. And look where you've been up to. You've been up to literally touch it this now, and then it's come off. So this is where there's some resistance at the moment. And that's why the market's sort of falling off this 138 area. So it's just worth knowing that some long-term people might be taking a bit of profit. They might just be saying, right, we bought it earlier, it's up here, we'll take some profit. Doesn't mean the move's over. We're only halfway through the year. So there's a good chance, you know, we could see price above there. But I'm just saying that is a resistance area to know about. So if we go to the next slide, thanks. We've got the sterling dollar quarterly chart. And I've split this into two just to sort of show. So we had that move from 2022 up to 2024, and then price came back down. Now, like sterling euro, where is the key area I always talk about? It's 38.2%. And you can see at the start of this year, price rallied off that 38.2% and went back up. So now we know where we're rallying off. We're rallying off that 38.2%. We can go to the next slide and say, where does it look like we're going to go? And what we're going to use are some Fibonacci extensions here. So we take that initial move, we do the pullback to that 38.2% from the other chart, and then we put extensions on going up here. So you can see here that the 50% is also sort of just prices playing around there, that 136.40 area. But where does it get to above there? Above there is 140 and 144.5. Now that's the 61.8, 76.4%. So if price does go up, I'd expect resistance at 140 and resistance at 144.5. But we've got to remember that 138 area. But this on the quarterly chart does tend to suggest that there could be a chance we go up and test into that 140, 144 area. And if we look at the next slide, please, this is a quarterly chart, and I've done retracements here. So we know where we look like we could be going on the extensions, but let's just look at the retracements and see, are there any levels that come in? Now, the 50% is 137.72, which is close to that 138 125, wherever we were looking. So you can see that's really where it actually came off. You've also touching the base of the Ichimoku cloud. So that's acting as resistance. But it's interesting. So that 137.72 is near the 138. We know that 140 area as well. And then we had 144.5 area. But at the 61.8% of the move since 2015 down, and the 38.2 retracement of the whole move down since 2011, they both come in at 145.80 area. So I'd look, if we do get above 138, 140, then I'd expect 144.5, 145 to be a strong resistance area. So one thing that's very important here is from 2008 all the way down to 2023, you were in a bear trend. Sterling dollar was negative on the quarterly chart. You made lower lows and lower highs. Classic definition of a downtrend. That started to change. 2024, you're starting to make, and 2024 and 2025, you're starting to make higher highs and higher lows. So this might be quite a significant change for sterling dollar. It still has some hurdles to clear, but it's starting to look more like an uptrend. So that's a good thing if you want sterling dollar higher. And then finally, just one other thing I would say is, we can summarize this in cable if you want by just saying, look, support should be in the 129, 132 area. If it starts to break below that, then this trend that we've been looking at this uptrend from the last few years starts to look worried. And you could see a slip down towards the 124, 125. But I'd expect that 129, 132 area to be support on any initial test down there. Resistance, we know, was that 138, 140 area. So look for that sort of be a resistance area. If that does break, I don't see much between 140 and 144.5, 145.5. But there's one thing always in the back of my mind. Whenever I do sterling and look at sterling on a chart, it says, is there going to be a collapse in sterling? Sterling seems very good at shooting itself in the foot, whether it be a political or some sort of event. And I'd just say, I wouldn't be surprised after the summer, we come into September, October, on a cycle sort of basis, you might start to see a bit of a sort of, I don't know the words collapse, but a pullback on sterling. But I'd just be a bit wary of that, always in the back of my mind, just sits there. And the last slide is just one to say, look, let's just strip everything off and look at the Bollinger Bands and that 20 period moving average. So on here, you can see that 129 is the 20 period moving average. So again, that gives us some sort of hope that 129 area should be good support. You can see there 142, 143.20. I think by the time sterling dollar goes up, that will have moved up as well. If it goes up, I'm saying if sterling dollar does go up, that'd be sort of nearer the 144, which again comes in with that sort of 144, 145 if we get a strengthening of sterling against the dollar continues to weaken. And with that, it's just the disclaimer slide on the next one, I think, which disclaims me of everything I've just said. But hope you found that interesting. If you've got any questions, please ask.
Thanks very much, Piers. Super interesting stuff. It was interesting you were talking about the weaker dollar trend. That's obviously something that we also agree in terms of fundamentals. We talked about sterling dollar also moving higher. We will have a forecast for 140. It'll be interesting if we get there. And also struck by the last couple of comments about coming back at the end of the summer, and I talked about fiscal risks for sterling as we get into sort of late October, November around the budget. So it'll be interesting to see whether the fundamental outlook and the technical outlook sort of collide. Interesting to see what that would mean for sterling going into the final quarter of the year. So I think that's all that we've got time for this month's UK FX webinar. I'd just like to thank Piers once again for his excellent input. And with that, I'll draw this month's webinar to a close and just say thank you for joining, and I hope you can join for the next